Welcome to another episode of the Riffle podcast, brought to you by 10 Leaves. You know, when you visualize the global financial system, you probably don't picture something particularly flexible.
No, definitely not.
Right. Most of us imagine these towering skyscrapers of glass and steel or massive subterranean vaults and, rulebooks so thick they could literally stop a bullet.
Yeah, it's an environment built from the ground up on strict compliance. It's all about exact numbers and absolutely zero margin for error.
Exactly.
I mean, it's a system actively designed to be inflexible because, well, in finance, surprises are generally synonymous with disasters. Predictability is the ultimate goal.
Which makes sense. You want the rules written in stone.
Or at the very least, an incredibly dense, uncompromising legal text that leaves, absolutely no room for interpretation.
Right, which raises a really fascinating dilemma. What happens when the real world just refuses to cooperate with that predictability?
Yeah, when things go sideways.
Exactly. What happens when a completely unexpected massive crisis hits and those rigid systems are suddenly forced to operate in an environment of, well, total chaos?
That is the big question.
And answering that is the mission of our deep dive today. We've gotten our hands on this short, incredibly dense, but deeply revealing strategic document. It was recently released by the Dubai Financial Services Authority, or the DFSA.
Right, the DFSA.
So our goal for you today is to translate this heavy piece of regulator speak into plain English. We want to extract the core insights on how major financial hubs try to bend without breaking.
And to fully appreciate what's in this document, it really helps to establish exactly who is issuing it.
Yeah, lay the groundwork for us.
So the DFSA is the independent regulator that oversees pretty much everything. We're talking banking, wealth and asset management, capital markets, insurance.
Basically, the whole financial ecosystem.
Exactly. And they oversee all of this within the DIFC, which is the Dubai International Financial Center.
Okay, got it.
So the source material we're analyzing today details a very specific package they've rolled out. In the document, they call it their temporary and proportionate regulatory relief measures.
Okay, and before you tune out thinking, well, I don't work in a high-rise bank in Dubai, so why should I care about regulatory relief? Let me tell you why this document is so compelling.
It really is.
Even if you are miles away from the world of global finance, this is just an absolute masterclass in crisis management.
Oh, 100%.
It provides a blueprint for how incredibly complex critical systems manage to survive what the document actually calls an exceptional operating environment.
Right. It's all about creating system flexibility without inviting system collapse, which is, easier said than done.
Yeah, it's the ultimate tightrope walk.
It really is. The primary purpose of this DFSA framework is to support both new firms seeking authorization and the existing firms that are already operating in the DIFC.
So they're trying to help everyone across the board.
Exactly. The goal is simple in theory, but incredibly hard in practice. They want to let these firms continue serving their clients and the broader markets despite whatever operational chaos is happening globally.
Right.
But they have to do it without letting the system descend into, well, lawlessness.
It is a phenomenal balancing act. While I was reading through the source text, a comparison actually came to mind.
Oh, yeah. Let's hear it.
So imagine you have this infamously strict university professor, right?
Mm-hmm.
You have a massive final paper due, but a hurricane just hit, and the campus library is totally flooded.
Okay, a disaster scenario.
Right. So the professor issues an announcement granting everyone an extension. They are acknowledging the reality of the situation.
Giving them a break.
Yeah, giving you more time, easing the immediate logistical pressure. But they are abundantly clear that they still expect an A-grade essay when you finally hand it in.
I like that.
They aren't grading you on a curve. They are just giving you the breathing room to actually physically write the paper.
That captures the dynamic perfectly, actually. They are adjusting the parameters of the logistics, but definitely not the standard of the outcome.
Right.
And you can see this philosophy clearly in the specific wording used by the DFSA leadership in the text. There's this crucial quote from Mark Stewart, the chief executive of the DFSA.
What does he say?
He points out that DIFC firms have demonstrated great resilience and financial strength during this exceptional period. But the most important phrase he uses is that this regulatory relief is meant to be a bridge to the resumption of normal trading.
A bridge over a chasm.
Exactly.
It implies that the current chaotic situation is merely a gap they need to get across. It's not a brand new permanent destination where the old rules just, no longer apply.
Precisely, because a regulator's absolute worst fear during any macro crisis is contagion.
Contagion, yeah.
It's that terrifying process where basic operational hurdles, like, staff just not being able to get to an office building,
Right, logistical stuff.
where that logistical stuff morphs into actual financial failures that spread through the whole system.
Oh, wow. Yeah.
So by offering this assistance on request, they are building that structural bridge. They are proactively rolling out temporary flexibility to prevent operational friction from becoming an existential threat to these institutions.
Okay, so if they are building this bridge, what exactly are the planks made of? How do you actually ease operational challenges in the highly regulated world of finance?
Well, the document breaks down this targeted relief into 4 headline areas. Let's walk through them.
Let's do it. Pillar 1.
The first area is all about authorization, licensing, and administrative requirements.
Okay, so getting a new financial firm authorized and licensed in a major hub, which is notoriously rigorous.
Oh, yeah. We are talking mountains of paperwork.
Yeah.
Incredibly strict deadlines, deep background checks. Under normal circumstances, those timelines are just non-negotiable.
If a new firm wants to set up shop, what does that vetting actually involve?
It involves complex anti-money laundering checks, verifying ultimate beneficial owners across multiple jurisdictions, and, getting physical documents stamped by embassies.
So highly administrative physical stuff.
Very much so. But the DFSA states they're offering flexibility, where appropriate, in the application and supervisory timelines.
Because of the chaos.
Right. They recognize that if a firm's home office in, say, London or Singapore is locked down or dealing with a crisis, they literally might not be able to get a physical signature.
Or process a background check within the standard 30-day window.
Exactly. So bending the timeline is just a pragmatic necessity at that point.
Okay, but getting the license is only step 1. Let's look at the operational reality of this document. It explicitly mentions providing flexibility around governance and staffing arrangements.
Right, that's the second pillar.
And it does this to reflect, and this is a great piece of regulator speak, evolving staff location dynamics and the continued integration of remote working practices.
Evolving staff location dynamics, it's a very polite way of saying everyone is suddenly working from home.
Yeah, which is a monumental shift for the financial sector.
Oh, it really is. It changes everything.
Think about how a traditional trading floor is actually designed. It's built to be a compliance panopticon. Right?
Yes. Everyone is visible to everyone else.
Exactly. Regulators require exact knowledge of who is making trades, where they are making them from, and who they're talking to. Phone lines are recorded.
Computer screens are surveilled.
Right. Compliance officers literally physically walk the floor to make sure a trader isn't pulling out an unmonitored personal cell phone.
Yeah, the physical sightlines are a core part of the security apparatus, which is exactly why remote work has historically been a massive red flag in finance.
Right.
The second you send a trader home to their living room, you lose those physical sightlines. They are suddenly operating on a consumer-grade router, potentially sitting right next to an unmonitored smart speaker.
Yeah, and Alexa just listening in on billion-dollar trades.
Exactly. So when the DFSA says they are adapting to changing staff locations, they are essentially taking on a huge compliance headache.
They really are.
They are acknowledging that a firm's key compliance officer might be stuck in another country, or the traders are literally working from their kitchen tables due to the crisis.
But tying it back to our professor analogy, the DFSA isn't just shrugging and saying, sure, trade from your kitchen, we don't care.
No, not at all.
The A-grade essay is still due. The firms still have to prove they have the actual controls in place, even if the physical location is changed.
Exactly. They still have to demonstrate secure virtual private networks, remote screen monitoring, and digital communication surveillance.
So the regulator is just offering flexibility on the governance structure surrounding those controls.
That is the crucial distinction. They are working with the firms to figure out how to replicate that panopticon digitally, rather than punishing them for not being in the glass skyscraper.
Okay, that makes sense.
And that logistical flexibility flows right into the third major pillar of relief the document outlines, which is regulatory reporting and supervisory processes.
Regulatory reporting, let's unpack that.
The DFSA states they're offering extended timelines to allow firms additional capacity to manage operational challenges.
We should probably clarify what regulatory reporting actually entails, because it's not just, filling out a quick multiple choice survey.
Oh, it's far more intense than that.
Right. For a major financial institution, regulatory reporting is an immense daily administrative burden. Banks have to submit incredibly detailed data dumps, proving their liquidity coverage ratios.
Their capital reserves.
Exactly. And their exact risk exposure at the end of the day, the primary mechanism the regulator uses to ensure a bank isn't secretly highly leveraged and about to go broke.
Right. And gathering that data requires massive IT systems and huge teams of analysts. It is a heavy lift on a calm day. Now imagine trying to aggregate all that data when your operational staff is stretched to the breaking point. They're dealing with a crisis, working remotely, and just trying to keep the firm's basic client services functioning.
It would be impossible.
If the regulator stubbornly demands that 500-page capital adequacy report on an arbitrary Tuesday, they are actively forcing the firm to pull resources away from crisis survival.
Right, they would be forcing the crew to focus on painting the ship while there's literally a hole in the hull.
Exactly the right image. So by extending these reporting deadlines, the DFSA is explicitly telling firms to prioritize critical day-to-day survival activities.
Keep the markets functioning.
Keep your clients' assets secure. We can review the detailed liquidity snapshots a few weeks later when the immediate fire is actually put out.
Which brings us to the fourth pillar. The document applies that exact same logic to implementation timelines for new regulatory initiatives.
Yes. The DFSA notes they will postpone selected new initiatives, provided that the postponement doesn't undermine the ultimate regulatory outcomes.
Which is just pure pragmatism, right? Regulators are always rolling out new, updated rulebooks.
Always. Maybe it's a new global standard for how to calculate credit risk or a brand new cybersecurity framework.
And complying with those new rules usually requires a bank to completely overhaul its internal IT systems.
Which takes months of work. Hitting a firm with a mandatory massive IT overhaul requirement right in the middle of an exceptional operating environment is basically setting them up to fail.
So pausing it frees up the capital and human resources the firms desperately need to navigate the actual storm.
Exactly.
Okay, I have to step in here and play devil's advocate for a second.
Let's hear it.
We are talking about stretching the timelines for vetting new firms. We are allowing traders to work from outside the surveilled trading floors. We are delaying the massive data reports that prove a bank's financial health.
All true.
And we are pausing the rollout of new safety rules. I mean, doesn't this sound like a recipe for a shadow banking crisis? Aren't we basically inviting chaos into a system that relies entirely on strict oversight?
It's a very fair question. Any seasoned regulator would share that exact anxiety, which is why the DFSA addresses it head-on.
How so?
The rebuttal to that criticism is built into the fundamental architecture of the framework itself. If we look directly at the source text, these relief measures are explicitly constrained.
Okay.
They are designed to be risk-based, proportionate, and time-limited.
Okay, let's break down how those constraints actually work in reality. Time-limited is straightforward. Like you said earlier, this is the temporary bridge, not a permanent new highway.
Right.
But the phrase risk-based and proportionate is where the real regulatory science happens, isn't it?
Yeah.
The document emphasizes that release is applied in a manner reflecting the nature, scale, and complexity of the individual firm.
Yes, and that phrasing is key. It means the relief is not a blanket free-for-all.
Right.
Going back to your analogy, the strict professor isn't just shouting everyone gets a 1-month extension with a bullhorn. The flexibility scales with the complexity and the systemic danger of the institution.
Think about the massive difference in risk profiles here. Let's say you have a systemically important multinational bank operating out of the DIFC.
Okay, a huge player.
Right. They have billions in highly leveraged derivatives and thousands of counterparties. The level of risk they pose to the overall system is just astronomical.
Oh, absolutely.
The DFSA is absolutely not going to let them pause their daily liquidity reporting. Because if that bank wobbles, the whole region feels the earthquake.
Exactly. But consider the alternative scenario. You have a small boutique wealth management firm with, say, 10 employees.
Very different scale.
Very different. They only handle a very specific, unleveraged portfolio of long-only equities for a few dozen clients. The systemic risk they pose is practically zero.
Right. If they have an IT glitch, the global markets aren't going to crash.
Exactly. So the DFSA can look at their specific situation, evaluate the nature and scale of their operations, and say, yes, given the crisis, you can have an extra month to file your administrative compliance report. The relief is highly targeted.
It's surgical. They are evaluating how badly each specific student's neighborhood was hit by the storm and granting extensions proportionally based on their actual situation.
And the importance of their specific assignment.
Right. And this brings us to the ultimate bottom line of the document, the uncompromising fine print that the DFSA really wants everyone to see.
Yeah, they make this very clear.
The text heavily emphasizes a critical caveat. It explicitly states that regulatory standards and supervisory expectations remain completely unchanged.
Unchanged, that's the key word.
The release is meant to support compliance and resilience. It is absolutely not meant to dilute regulatory requirements.
Right.
Why are they pounding the table so hard on that specific point? They're essentially repeating, we are being flexible, but we are not lowering our standards.
Well, if we zoom out, the document states the DFSA's commitment to safeguarding the integrity and reputation of the DIFC's financial services framework.
Oh, reputation. Yeah.
Exactly. And in the world of high finance, reputation is quite literally currency.
It is the only thing that matters, really.
The DFSA notes they are coordinating with the wider DIFC community, other UAE authorities, and international partners. They are doing this because the DIFC isn't just a local banking hub.
No, not at all.
It is the leading international financial center for the MESA region, so Middle East, Africa, and South Asia.
And capital is incredibly skittish. We've seen historically how fast electronic bank runs can happen.
Terrifyingly fast.
Yeah. International banks, global hedge funds, massive sovereign wealth funds, they only park their billions in jurisdictions they fundamentally trust.
Right. They need absolute certainty that the regulator overseeing the market is sharp, competent, and unyielding on the core rules of fair play and financial stability.
So if the international community gets even a hint that a financial hub is using a crisis as an excuse to permanently lower its standards,
or that it is becoming weak on oversight,
right, then international trust just evaporates overnight.
And when trust evaporates, capital flees instantly to a safer jurisdiction.
Which highlights the intense dual role the DFSA has to play here. Internally, to the firms operating inside the DIFC, they have to be this sympathetic, practical partner.
They want those businesses to survive the crisis and keep operating.
Right. But externally, to the rest of the watching world, they have to present the face of a tough, uncompromising cop.
Yeah, they are broadcasting a message. They're saying, we are helping our local firms weather the storm logistically, but don't you dare think for a second that our vaults are unlocked or our standards have slipped.
Exactly. They are bending the logistics of how and when a firm proves it is compliant, so they don't have to give a single inch on what it means to be compliant.
The core standard remains identical.
It is a brilliant piece of strategic positioning, honestly, to offer a vital operational lifeline without lowering the bar.
It's very well executed.
So to recap this deep dive for you,
Yeah.
faced with an exceptional operating environment, the DFSA is providing targeted breathing room to the DIFC financial community. They are stretching licensing timelines, accommodating the incredibly complex reality of remote work governance, and delaying massive reporting burdens so firms can just focus on survival.
But they are doing it carefully.
Yes, through proportionate, risk-based application. They are stubbornly protecting their high regulatory standards and their reputation as a premier global financial hub.
They've engineered a sturdy bridge over the crisis.
Sturdy bridge.
But, analyzing this document leaves me with a lingering, somewhat provocative thought.
Oh, what's that?
Well, the DFSA repeatedly emphasizes that these measures are a temporary response to an exceptional period. They are meant to be a bridge back to normal trading.
Right. Back to the old normal.
But consider what happens once the financial sector successfully crosses this bridge. Once these massive, highly complex firms actually prove that they can maintain strict regulatory standards while utilizing remote work setups.
Oh, I see where you're going with this.
Right. Once they demonstrate that slightly more flexible reporting timelines don't actually result in systemic collapse, will they ever truly want to cross back over that bridge to the rigid, uncompromising old normal?
That is a fascinating implication.
Yeah.
I mean, if you force a rigid system to bend and you discover that it still functions perfectly well under the worst possible stress.
Why would you force it back into the rigid mold when the sky is finally clear?
Exactly. Does a temporary crisis relief framework accidentally draft the blueprint for the permanent future of financial regulation?
It makes you wonder, when the storm passes, do we rebuild the strict university library exactly as it was, or do we realize that maybe the students can write A-grade essays from their own homes?
It really raises the question of whether normal was just an outdated habit all along. Bending without breaking might just teach you a better, more resilient way to build in the first place.
Absolutely.
Well, thank you for joining us on this deep dive into the source material. We hope it gave you a little breathing room in your own day and a new perspective on how the world's most complex systems navigate chaos.
Until next time.
Keep questioning the rules and keep exploring the deep end.